to the lecture for the first part of Chapter 7. In this chapter, we're going to deal with receivables. So that's the amount that our customers owe us for work we've done for them or products that we've given to them. And it arises when we give customers credit or bill them on account. Okay, and you'll remember that from past chapters. So in this portion, I'm going to talk about receivables in general, different types of receivables. I'm going to give you some tips about how you can possibly avoid having bad debts or having to write off your receivables. And I'll talk about the direct write-off method and then give you an introduction into the allowance method. And then on the next lecture, I'll talk more about different estimation methods, percentage of revenue, percentage of receivables, and the allowance method using the aging. And then I'll talk about notes receivable and credit card sales as well. That'll be in the Part 2 lecture. So first of all, different types of receivables. So accounts receivable is a relatively informal kind of receivable. So it arises when, say, you as a customer give me as a supplier a purchase order, and I provide you with the services or the goods, and I send you an invoice. So that's a really common everyday kind of transaction that occurs. Technically, a contract does exist, but it's not really a written contract that we've both signed. So that happens all the time. And most businesses offer credit, so they bill their customers on account, and then the customer pays under the terms, for example, 210 net 30 that we talked about last chapter. So they take their discount if they pay quickly or they pay in 30 days. Sometimes we'll want a more formal arrangement with a customer. Maybe it's a large amount or it's a customer that we're not really familiar with. And in that case, we'll issue a note receivable instead of an account receivable. So that's going to be a written document that outlines what the customer owes, if there's a provision for interest, and what the consequences are of not paying. So maybe there's collateral that could be seized or those kinds of things. So in that case, a note receivable is easier to collect on than an accounts receivable. So if somebody's absolutely avoiding paying you and you have to actually take them to court to get a judgment against them, that's much easier to do with a note receivable than an account receivable. So sometimes a note receivable will arise as part of a sale. So I'll increase note receivable and increase retained earnings for my revenue. And in some cases, I might have an accounts receivable and I want to, the customer's not paying, and I come to them and say, you know, we need to have a more formal arrangement here. And so I'll take away the accounts receivable and replace it with a note receivable. So I'll tell them I need you to sign a document in order to move forward. So that's, they can arise either way. We'll also have other kind of more minor receivables. That might be interest that is owed to us that we've accrued in a year-end adjustment, which we'll talk about on Friday. It may be loans to employees or loans to officers in the company, those kinds of things. But those are usually smaller amounts, but we report them separately so they're not included within our accounts receivable. So an uncollectible account is when we've granted a customer credit, so we've given them products or services and told them they can pay in 30 days, and then some of them don't pay. That's inevitable. It happens, unfortunately, in just about every business. So the expense associated with writing off a debt, so writing off an amount that somebody owes us, is called uncollectible account expense. Some businesses call it bad debt expense. That's the same thing. And there's two different methods used to do that. One is a simple method called direct write-off, and the other is a better method, but a little more complicated, called the allowance method. Before we get into those two methods, I want to talk a little bit about some practical things you can do to limit uncollectible accounts. So these are indications that you might have a problem with collection. So the first one, the most obvious, is that the receivable is past due. So the one thing that you can do that is the easiest thing to do, and I think the most effective thing to do, is to be really, really diligent about contacting customers the moment their receivable goes past due. So in my company, that was somebody's job, and they would run a report every day of any receivable that hit 31 days, and they would call those customers on the 31st day. And it's not enough to call them and say, hey, I just want to let you know your bill's past due. Okay, have a good day. It's a matter of saying, when is this scheduled for payment? Or if you've sent a check, can I get the check number and the date it was sent? It's about getting specific information or specific promises from a customer, and then making note of that and then following up. So if the customer says, say the 31st day is a Friday, and the customer says, we're going to pay you next Friday, then you make a note of that and you call them the next Friday and verify that the check went out. This kind of gets to the old adage that the squeakiest wheel gets the grease. So you want to be the squeaky wheel, not to the point of being rude or abusive, but just to be diligent and dogged in your efforts. The next indication you might have a problem is that the customer doesn't respond to your inquiries. So you can try different ways of reaching them. I wouldn't be above going physically to their location if that's necessary, but sometimes people will try to hide from you, and you need to be creative about how you track them down. Another problem might be a customer files for bankruptcy. So that's a legal protection that a business can get that will either allow them protection while they reorganize their business, so kind of put a hold on collection efforts, or it could result in the liquidation of the business. So in either case, you'll receive a notice from the court, and it's important for you to respond to that notice and file a claim saying, hey, this company owes me money, so that you're in line for payment. Next could be a customer closes their business, so then you've got to track them down. That could be difficult. And then sometimes you can have a problem where you just simply can't locate a customer. And that may be the point at which you say, okay, this is uncollectible, I have to write it off. Or you may hire an investigator or take further steps depending upon the amount that's owed to you. So now let's go back to those two methods. So the first method here is the direct write-off method, and it's generally not accepted under GAAP. It's only allowed to be used by companies where their sales on credit are a very small proportion of their overall sales. So say you own a restaurant and 90% of your sales are individuals that come in and pay cash for their meal. But every once in a while you bill a company for a party that they have at your restaurant or something like that. And so you might have a very small amount of receivables. And in that case, it's okay to just write them off as you determine they're bad. So in this case, we bill customers for $100,000 worth of products and recognize the revenue. We get $80,000 in cash and reduce our receivables. And then in step 3, we decide, of the $20,000 that's still owed to us, $1,000, we can't find that person. We think that's probably going to be bad. So we write it off and recognize an expense at the time we write it off. That's the direct write-off method. Well, that's fine, but the problem is it does a poor job of matching. So say if that step number 3 there occurred in year 2. So now year 2 looks bad, year 1 looks great. So we've done a bad job of matching expenses with the revenues they're associated with. So that's the downside to the direct write-off method. So at this point, I'll have you take a look at watching the video for exercise 7-9B and using your working papers to kind of go through these steps for that. So the next thing I want to talk about is the allowance method, which again is the preferred method for doing this. So the allowance for doubtful accounts is a new account that we're going to be using, and it's a contra account. You remember back when we talked about depreciation, I think it was in chapter 3, we had an account called accumulated depreciation that had a different type of balance than its neighbors. So it had a negative balance next to the asset that had a positive balance on our grid. The allowance for doubtful accounts is going to be similar to that. It's going to have a negative balance, and it's going to be right next to accounts receivable on our grid and on our balance sheet. And it's going to have a negative amount, okay? So when we make an estimate at the end of the year and we create our allowance for doubtful accounts, we're kind of creating a provision for future write-offs. So we're building up that negative balance by making that entry. And then when we actually write things off later, we don't recognize an expense at that point because we already recognized it when we made the provision. So later when we write things off, we're going to take it out of that provision, out of the allowance account. So the way that looks on the, well, first let me talk about a little bit more. So this method requires us to estimate our allowance at the end of the year. And I'll talk on Friday about a couple of, or I'll talk in part 2, I apologize, about a couple of different methods for doing that estimate. And that's the point at which we recognize the expense. So we recognize the expense in the same period in which we've made the sales. So this is a better method for matching. So when we actually write something off later, we're going to reduce that contra account. So the net balance of the receivables account and the contra account, the allowance account, together is the net realizable value of receivables. So if $80,000 is owed to us on accounts receivable and we have an allowance of $4,000, our net realizable value, or what we think we're actually going to collect, is $86,000. So you can imagine if I was borrowing money from you and I was telling you that the amount that I'm going to collect from my customers is what I'm going to use to pay you, you'd really be interested in what the net realizable value is, because that's what I'm really going to probably get for cash. So let's take a look at some grids here. So in this case here, customer makes sale, or company makes sales on account, receivables goes up, retained earnings goes up. And at the end of the year, I use one of the methods we'll talk about in part 2 to estimate my allowance. In this case, the company estimates that $5,000 out of those receivables is not going to be collected based on some method of estimation, and we recognize the expense at that time. Notice we're not writing anything off at that time. We're making an estimate of future write-offs, but we're doing it in the period in which we've made the sale. So in that case, allowance for doubtful accounts, you see, has a negative balance there. So in this case, my net realizable value is $95,000. That's what I think I'm really going to get. So now, at some point in the future, could be the next year or the year after that, we decide that a particular receivable is uncollectible, can't find the person, they've gone bankrupt, whatever the case is, and we write it off. So when we write it off, we're going to reduce accounts receivable. Imagine we have a list of all the people that owe us $100,000. We're going to scratch one of them off, and we reduce our allowance for doubtful accounts. So when we do the write-off, you see we're not touching retained earnings. We're not recording an expense. The tricky thing here is notice that the reduction of allowance for doubtful accounts is a positive number. It reduces the negative balance we have. So once we've done that, now we only have a provision of $4,000 for future write-offs. So now this happens from time to time, not very often, but we decide to, we get paid by a customer that we previously have written off, which is always a good day. So in that case, the first thing we need to do is step 4, you see there, which is reverse the prior write-off. So we reestablish that receivable and we build our allowance back up. So we have a positive 1,000 under receivables and a negative 1,000 under allowance to build it back up. Again, there's no impact to earnings at this point, no expense or revenue recognized. Now that we've reestablished the receivable, we can collect on it like we normally would in step 5, which is increase cash and decrease receivables. So hopefully that makes sense to you. So that's the end of this part. If you have questions, please send me an email or give me a call, and you should be fully prepared to do the first exercise, the first assignment for this chapter. Thank you.